After a big announcement this week with the inflation rate, the market has done all of nothing. What in the world is going on? Riz and I are going to talk about it. Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to our market recap webinar. My name is Chris. We're part of Riz International, and we're a group of traders who are looking to make our money work for us and not the other way around. And before we get started, I'd like you to go ahead and smash that like and subscribe button if you are watching on YouTube. It really helps the channel grow. And make sure you click that bell icon so you get notified when we upload more videos to help you keep an edge on the market. But I have the man himself tonight. Riz, how are you doing?
Doing good, Chris. Yourself?
Doing fantastic. Glad you could come and join us out for another night, because it has been a very strange week. Because let me zoom in here on the S&P 500. I mean, we've done just nothing. I mean, there's been a lot of up and down intraday, but for the most part, the market is doing nothing but trading sideways. Riz, what's your take on this?
Yeah, I'm going to be very candid on this webinar. I'm going to tell you straight up, and everyone watching, it is horrendous. It is insanely frustrating. Sometimes it's visible for those of you in elite, from my constant updates. You may be able to pick up my mood and my tone, but if for those that haven't, and for those that are not in elite, it's very frustrating, even for someone like me, after God knows tens and tens and tens of thousands of trades, 15 years. I hate it. I kid you not. I hate when markets move like this. But here's the thing: no matter how many years, whether it's Warren Buffett or whether you've been trading for like 80 years or 75 years, whatever it is, or 5 years or 1 year, we cannot control the market, no matter how much money you have, no matter how much experience you have. So we're stuck. We're left with essentially being in charge and control of the parameters and variables that only we can control. And the market is one of them. And the fact that this continues to move sideways, Chris, you could see this, and members can see this. I think it's just at the start of April to now. And boy, oh boy, this 4,100 to 4,200 area in between is honestly, it's like Mariana's Trench. It just wants to just suck you in and screw you over, because ultimately, having this kind of choppiness, especially for those of us that are swing traders, and I would say every trading style, it is horrendous for every trading style. And I'm assuring you that there's going to be out there people on social media saying, "Oh, yeah, we're minting money and this it's amazing, and every day we're winning." Um, but the reality is very much different. Again, full transparency, it's been a great year so far from a trading standpoint, even with this choppiness from April to now. It's for a month and a half almost, but it's nonetheless frustrating. I would much prefer we have some direction. And by direction, I mean either a clear break upwards or a break downwards. If I had to have a preference, again, that's just me, I would prefer a little bit of a pullback, but we know the market is extremely resilient. It does not want to effectively pick a direction, and even if it does, there's no guarantee it's going to go down, right? We always assume, oh yeah, there's the crashes, just right around the corner, and oh yeah, the market's definitely going to puke. Oh yeah, the economy is definitely going to crumble. Well, here we are, almost literally a month away from half the half part of 2023. So the market's still holding up. You can see it's clear as day. It's actually a relatively decent uptrend from October onwards of last year. So for everyone last September, October that was holding out for a bigger drop, they have been left unsatiated. They've been left probably a bit deflated, right? And one thing I also want to clarify is a lot of people ask me, because I'm transparent with not only my positions in Elite, but also my cash position. And I'm open with my cash position in terms of how much cash I hold as per the account value, as opposed to the open positions. And I say that outside of elite as well. So right now it's about 85%. For those of you in elite know that we did take a couple of positions. Again, that's not going to be made public, but I'm about 85% cash. And people are always like, Ridge, you're 85% cash, you're missing this rally. No, I'm 85% cash, but that doesn't mean I'm not trading. It doesn't mean I'm not utilizing other strategies to derive and extract profits, right? For those that are savvy, those that have been paying attention and are able to utilize and understand the various different strategies that I and others in Elite use, you know that we're able to generate, you know, profits, capital, cash flow without having to just buy and hold or short or buy and pray, right? We can buy stocks, we can swing trade, you can day trade, you can use stocks and options, but there's clever ways to do so without having one-to-one large amounts of exposure to the markets. So you can buy your time, and I've been very open with not only the trades I take, the entries, exits, but also my cash position along with my win loss percentage, which is around 75% as of Friday. It's about 75% now. Our short puts, our Raptor method is 100% win rate. So I'm pretty pleased with the results. Again, I've also shared in Elite the performance, which is roughly about 20% or so year to date. And for people that are thinking, Rich, I thought it'd be 50% or 100%. Well, yeah, I'm not trading with 5 grand, or I'm not YOLOing on all in on options, right? The more money you make, here's something people won't tell you. The more money you make, the less you have to be greedy, the less risk you have to take, the less uh, extravagant you need to be with your trading, right? Once you have a few million in wealth, once you have a couple million in trading accounts, once you've done it for 15 years or whatever time frame, you realize you don't need to stick your neck out there and either come out like a hero or come out with no neck or head, so to speak. So I trade in a way that year after year after year, I'm generating a positive return. I have less volatility in my portfolio. I have less, I would say, exposure to markets in a given year. I have positive risk reward. I have a lot of these metrics that you really want to track and be aware of, very fine tuned, right? So the reason I'm going into that is because sometimes you're going to have markets, like we said, they're not doing anything, they're moving sideways. That's where you sit back. You can trade, cautiously, but you can look back and see, how am I doing as an individual trader? How much am I trading? How am I trading? And not just during this choppiness, but during the year, or during the last 1 year, or during the year to date. Sit back and reanalyze, because far too many people solely focus on markets and what stocks are moving and politics and the economy and inflation, but far few people pay attention to themselves. How are they interpreting the markets? How are they participating in the markets? How are the actual hardcore numbers and metrics coming down to? Because ultimately, that's all that matters. The market can go up 10%, but you could misread it. You could have horrible risk reward, or you could have horrible entries and exits. You could FOMO, or you could just completely be, not wanting to participate at all, and you could miss out. Or these are things that will depend very much on your decision making. And same way for me, the decisions I make will impact me. So it's very important to separate yourself from the market performance. Even though I'm happy with where I am right now, there's no guarantee. I'm not immune to drawdowns. It doesn't mean I'm going to close the year plus 20% or plus 30%. It doesn't mean any of that. I'm just sharing it at this point, like a screenshot, of this point in time where I am. And that doesn't mean it's right or wrong. If you're maybe up 5%, maybe you're up 10%, maybe you're up 50%, whatever the case is, it's very individualistic.
Guys, this is the type of information that you should be coming to webinar for, because you're not going to hear this anywhere else. Like Riz was talking about, you're going to see on Instagram, everybody, I'm like, oh yeah, I made X amount of dollars on this trade, and here's this screenshot that maybe I altered, maybe I didn't. But this is the information you really need to come from. If you really want to build long-term wealth, this is kind of the outlook you need to have. And this is something you're not going to hear other places, because they don't want to tell you this. They always want you to think that it's all, sunshine, rainbows, and bags of cash, and it's just not. Sometimes it is that slow incremental growth, that return that really works for you, and that's really where we want to get you guys to. So, Riz, that's some amazing insight that I don't think that you're going to hear anywhere else, if you ask me. But let's go ahead and take a look at the breakdown here for the S&P 500 and look what's going on. And man, communications and tech just keep riding high, while we've got consumer discretionary really going pretty up there as well. But S&P 500, you can really see how flat the S&P is here on this chart. This really shows it to you pretty clear as day, like we're talking about. And honestly, what Riz is talking about from the beginning of April to now, I mean, you can see my crosshairs there. It's basically no change, for lack of a better term. So S&P 500 really kind of taking its time and just chilling out a little bit. We've got, looks here, consumer staples are up. Real estate's starting to creep back up, but our typical our usual suspects, I'd say utilities, healthcare, energy, and financials, all in the dumpster right now, below the zero line. Riz, what's been going on in communications? Because we've been seeing a real big spike in this. Tech has been riding high for a while, but man, communications really making a move here.
Yeah, risk on environment. We see that with utilities being below the positive line, which is consolidating. We've seen obviously financials have been very risky, very volatile this year over the last few months, especially if you've been paying attention to the whole banking fiasco in the U.S. With the regional banks. So there's no surprise there. Energy has actually been pulling back, even though we're heading into the summer months. It's holding. I firmly believe that with the OPEC cuts kicking in, production cuts kicking in, we might, especially with this summer season, might see a little bit of an uptick in oil prices. But again, for now, oil prices are a little bit depressed. I remember start of the year, people were like, you know what, if you thought last year was bad, we might see oil prices go to 150 or $200 a barrel. And I would roll my eyes and be like, here we go. More doomsday, more fear, more bullshit headline stuff. And guess what? Oil is around the $70 mark, a far cry from the 150 and $200 mark people were trying to scare people in. But hey, that's the current environment we live in. So yeah, again, nothing surprising. SPX still moving sideways, like you said, Chris. The obviously tech, consumer discretionary, them really kind of moving up, and even consumer, what's it called, the communication sector moving up, not surprising at all, and really leading the gains. In fact, if we take a deep dive into the S&P 500, the 500 companies that make up the index, there's actually a very few companies, obviously within the communication tech and the consumer discretionary sector, that are leading the market and pushing it up. Otherwise, there's plenty of stock that are just kind of curled lower. And the reason the index is still holding up at this levels, I reckon, is simply because of these other companies. Think Apple, think Microsoft, so on and so forth. They're really holding up the market. They're leading the market, holding it up. If it weren't for them, I am confident you would see the SPX pull back, curl down lower. Because there are other companies that are part of the index that have taken a beating. Think oil companies, think financials. Those things are part of the index too, and they've actually pulled back. And that weakness in those companies is offset by the strength and the massive rally in the tech and communication sector. So it's kind of a mixed bag. If we see the other sectors continue to remain weak, like financials, energy, and even healthcare to a certain extent, and we see tech communications pull back, then that's going to break that 4,100 to 4,200 consolidation zone that we've been in. It's going to break that. And that's what I'm kind of waiting on. Of course, we've pretty much done with the main core earnings of the large companies. We have obviously some earnings continue, but it's smaller companies, more, I would say, growth, smaller companies, growth tech focused companies. But the major top dogs have already reported, and earnings weren't too bad, weren't too shabby. Hence why, another reason why tech is holding up strong, and as a result, the market's also holding up. It's not going up, up, and up, but it's just holding. It's holding its ground. So usually we want to interpret this as, if I had to say one way or the other, it's a bullish direction, especially with unemployment actually ticked up last week. Um, but the market absorbed that news very well. So it remains to be seen how things go in the next month. We know the Fed already raised rates, and now the market's factoring in a pause. We really need to see in the next month or two how things go in that direction. But for those that have been paying attention and following along on the webinars, it's always like, oh, next month, oh, next month. So you'd be right in thinking, well, it never ends. It's always like, what? Let's see what happens next month. Let's see what happens after the month after that. And you'd be right. It's a constant journey. It's a constant. You turn the page and there's another page. You turn that page, there's another page. So anyone that tells you or leads you to believe it's just one binary event, one singular event, and then once you're done with that event, it's all clear cut. It's not, unfortunately, and that's what makes markets so challenging, exhilarating, and like nothing else. Because every day, every week, every month, every year is not like the past.
Very well said. There are definitely sectors that are pushing that market up and holding us up there. And if those do crack, it's going to be, well, not good overall. So we'll have to keep an eye on that for now. But yeah, definitely, there's always next month. There's always something coming up later to see what it's going to push the market towards. And Riz kind of alluded to this earlier. Oil being taken a bit of a beating here since about the middle of April. We came up and cracked through this channel that we had been in before, pushed up over about 82, and then after that we kind of dumped, and we've been coming down. Gold made this nice little run here. We came up, looks like we tapped, if I'm not mistaken, this was last week. No, it was this. Yeah, it was last week, last Thursday. A week ago Thursday, I should say. Gold came up here, came really close to this all-time high, but did not quite get there, and it is coming back down. But we are still holding over $2,000 an ounce at this point. Riz, you kind of alluded to the production cuts with OPEC making that announcement. Do you think that we should see more upside in oil here coming up, or especially heading into the summer months, which is obviously a higher
Yeah,
consumption
yeah.
time?
I'm waiting. I'm waiting for that 70 area. I remember last week I said, I might consider a position. I didn't end up taking any position. Luckily so, because I was leaning towards the bullish side, but I figured, nah, okay, I'm not going to chase this. I feel not too confident in what I saw on the day-to-day price action last week, so I did take it in terms of bullish trade. So luckily, I'm glad I didn't, because it did revert back and kind of come back down lower. So we are seeing oil kind of reach that 70 area. I would like to see it stay there, maybe go a little bit below. Maybe we hit below that 670 area, 68 or so. Then I'd say maybe we try and get it with a little long position. But again, you're going to have to be an elite. People are going to have to be in there to really know the real time moves that I'm making, um, as far as oil or any other trades.
Good to know. Good to know. And sometimes the right move is not to take a move at all, and you can see why right now. Sure, if you had bottom picked it, which is very rare, you could have made a small profit, but if you'd held on to it longer, you'd be about right back where you started. So sometimes you got to wait. You got to wait for the right moment. Obviously, that was not the right moment. Let's take a look here at the Treasury bond yields and the dollar. Honestly, I feel like a broken record here because the bond yields continue to basically trade sideways, kind of like the S&P 500, though we are seeing a bit of an uptick in the strength of the dollar here. Riz, what's going on with that?
Yeah, so we've seen a little bit of a shift in currencies. Nothing major, honestly. This isn't anything to be concerned about in terms of dollar strength. What same thing with bond yields. I said last week. I'm not surprised they're moving sideways. As kind of we come to that shift in monetary policy with regards to interest rates being the core focus, and with interest rates the benchmark interest rates will effectively have a ripple effect on everything, whether it's mortgage rates, whether it's treasury bond yields, whether it's high yield savings accounts, even the discount rate on the market. So with bond yields moving sideways, not surprised in the least. We really need to see, like I said earlier, in the next few months, what direction and what context and narrative we see from the U.S. Federal Reserve, from Jerome Powell and the gang, to see what they're saying, what signal they're giving. The current signal they've been given, Powell specifically, is that we, still see inflation obviously higher than their 3% target. It's around 5% almost, but it's definitely far below. It's pulled back really big from that 9% high that we saw, last year. So that's good news, but nowhere near that 3%, 2 to 3% range that they'd like. So their thing is, instead of dropping rates like what the market is pricing in or wants to them to do, their thing is they're saying, at least who knows what they'll do, but what they're saying is, we're going to plan on keeping rates here a little bit longer. So the market automatically thinks, okay, they're going to cut. And Powell has gone on record to say, no, we are not cutting, but we are going to wait this out till we get more data, till we see a little bit more of a cooling off in the economy. But on the flip side, he also says he doesn't see a hard landing, or in other words, he doesn't see that classical recession. Okay, not a 2008 situation, because that was a very, very major recession, significant recession, a financial collapse even. But this recession, he said, even if it does happen, would be very mild. But he's saying there's not going to be a hard landing, no hard, grueling recession. But we know they've been wrong. Well, to put it lightly, they've been wrong significantly many times. So I cannot tell you if we're going to see a recession or not. I cannot tell you if we're not going to see one. No one can. And if anyone's parroting that idea that, oh, we're going to see a recession for sure, oh, we're not going to see a recession at all, cut and run the other way, because that person is making their money by trying to mislead you. So we're in very much a wait and see mode when it comes to the Fed, when it comes to Treasury yields, when it comes to sort of that interest rate landscape, and when it comes to the broader market. Who would have thunk, right?
I just can't believe that Powell would say something that was incorrect. I mean, here I thought inflation was going to be transitory. There we go. I said it. So, yes, the Fed even itself can make mistakes, but yeah, don't expect rate cuts anytime soon. That's my opinion. I still think they need to raise them a bit more, but I'm guessing they're kind of holding off considering everything that's been going on with the financial sector. They kind of need to chill out a little bit and let everyone, kind of catch their breath. And I think it makes sense to just kind of hold here, see if we can get a cooling off of the economy, and then kind of go from there.
Absolutely, I agree with you. Yeah, I think they're a bit hesitant. They've gone on record and said, it's not the banking fiasco with the regional banks, that it's not systemic, that it's not contagion, it's not something that's, indicative of the banking sector, the financial sector health of the U.S. economy and the U.S. banks as a whole. They said it's maybe isolated, but that's what they say. Who knows? Behind closed doors, they might be thinking, well, maybe we want to cool off. We don't want to cause and be the cause of this next financial breakdown when there's no need for that. So you'd be right in thinking that, maybe they might want to raise, but they're giving everyone that kind of time to cool off. But who knows? From an inflation standpoint, this is relatively good. The market reacted well to a slight lower than expected inflation print. If, on the other hand, we saw like a 5.5% annualized inflation, then I think we'd be in trouble, because then that would tell us that the economy is still running too hot. Pricing pressure is still too high, and maybe the Fed needs to do another 25 basis point hike. But that's not the case, right? We saw inflation cool a little bit more. We've seen jobless numbers, unemployment numbers go a little bit higher. Nothing significant, honestly, nothing significant. But these are the metrics Fed's going to be looking at.
Absolutely. I want to go ahead and offer for all of our attendees here on our live webinar. Now's the time to go ahead and start posting your questions. But while you guys are typing, I want to go over the big dates this week in the market. And I only really see one that really is concerning me at all. And it's right here. Everybody's favorite Fed chair, Mr. Powell, is going to be flapping his lips on Friday. And when Powell talks, the market moves. Retail sales should be indicative of, how things are going, as far as, the sentiment from the consumer, being able to spend money at those retail places, and building permits. Always good to know if we're still building things. But in my opinion, big, catalyst this week is going to be Friday morning.
Yes. Retail is going to be a little bit of a big one. Take a look at that spread there, right? From the previous negative 0.6% in retail sales month over month, whereas you have the consensus for this one up 0.7. So those are big deltas. Who knows, right? That could be a bit of a surprise. But yeah, building permits, housing, it's actually in line. The U.S. continues to build houses. We did have a little bit of a dump there last year with a lot of that interest rate hike and velocity in interest rate hikes. Building permits went down. Not many houses were being built, but I think that's kind of normalized now. Whereas the Palace Beach, well, anything goes on Friday.
Yeah, you can definitely bet we're going to be listening to that one. That goes off, so that should be interesting to say the least. All right, Jeff wants to talk about IEP. So we had a little bit of a parabolic move down here. Looks like earnings were pretty bad, and this thing has been volatile as all get out. Riz, what's going on with this one?
Yeah, this has been something we've been on watch for a couple of weeks with IEP pulling back significantly after Hindenburg released a short report. I'll leave the details for people to look into, but ultimately, they give a short report. They said, things are not too ideal in the land of Carl Icahn, who's a notorious hedge fund billionaire, also known for being an activist investor. I'll help you look into him as well. It's actually a fantastic documentary on HBO about him. May want to check that out as well. But Carl Icahn, he's ran this Icahn Enterprises fund, this firm. As you can see, it's pretty solid in the terms of price action. Consolidated significantly, but of course, this short report broke the back of the stock and really got slammed. A lot of really, probably would say about probably a 30%, 40% drop from where it was. Now it picked back up a little bit, as you can see, with that 28, $30 mark acting as a support. We've traded this before. It's done well. We've actually traded it on Friday. I'm not going to give anything away in terms of positions, but yeah, looking really strong heading into Friday. The dividend is also coming on May 19th. I outlined this to elite members. May 19th, there's a dividend for I believe $2 per share. Yep, $2 per share. So if you have the stock in your brokerage account as of that date, Friday, May 19th, you could sell it, May 19th. You could sell it if you wanted, if you hold a position, and you would still be eligible to get the dividend that is going to be given out likely in, I would say end of June, and it says 30th June, but that can be up to change a little bit. So I would expect maybe 2 or 3 weeks after that, the ex-dividend date of Friday, May 19th, to get your dividend if you held the stock as of that date. Okay, and then you can do what you want with it afterwards. But something to know. And $2, if you think about it, is a sizable chunk from a per share standpoint. So it remains to be seen. Usually, when we see these dividends come out, the price doesn't completely discount $2 because the $2 dividend is a cash paid out from the company. It doesn't discount from the stock. It actually holds reasonably well. So here's to hoping that that's the case as well here for those that are in the stock as a buy and hold. But there's no guarantee because we've seen this massive volatility that's kind of broken the overall technical structure and the movement of this stock. We don't know. So we're kind of in like uncharted territory. How is the market going to react with this $2 cash payment after everything that's occurred with the Hindenburg short report over the last couple of weeks? Another thing to keep in mind with our Icahn Enterprises is they have issued or approved, I should say, I believe a $500 million share buyback program. So without getting into the details, generally speaking, all things considered, share buyback program for any stock, and not just Icahn Enterprises, but any stock is usually bullish. It's usually positive. That tells you that the firm, the company that's buying back their shares off the market is thinking, what, we're undervalued, or this is a good value to buy back our shares and take control of more of the company, right? So that's a positive sign. Does this mean guaranteed that the stock is going to go up? No, but I would say, it's definitely a positive sign. We don't have the details yet in regards to like pricing. Are they going to buy it on the open market? I haven't seen anything about regards to that, but I have just seen, roughly a $500 million buyback approved. So all things considered, there are some bullish currents and macro events and even I would say technical because it's bounced up from that $30 area strongly, and that $30 area has held in the past in the prior week. So something interesting for you guys that are not an elite, maybe this is something that you can put on your radar as well. Again, I'm not telling you what to do, and I can't go into what we've done, how we've traded this in elite. That's only for elite members to keep things fair. But yes, definitely something to keep an eye on for you guys.
Yeah, very interesting movement with this one. So definitely something to good. And yeah, Riz isn't kidding. $2 a share is not insignificant, especially on what's right now a $35 stock that took about a 44% hit. With this report coming out, so pretty good bargain if that's something you're into. Again, I'm not suggesting you buy it either, but something to consider. Riz, I wanted to go ahead and talk about the debt ceiling because everybody's talking about the debt ceiling right now. It's all over the news. People are talking about, the U.S. defaulting and things like that. Is that something that you think is holding the market in check right now because people are waiting to see if there's a resolution for that? Or do you think it's really not going to affect the market all that much?
Yeah, so right now we're obviously kind of in limbo. We know that Congress politicians, are kind of going back and forth. How productive they are, God knows, but they are quote unquote, trying to strike a deal. Uh, it would be if it doesn't happen, it would be the first time in history that the U.S. defaults on its debt. And it's not just this, oh, okay, defaults on its debt, big whoop. It actually has a significant impact on the not only the overall credit rating and the trustworthiness of the U.S. and the U.S. economy, but even internally, as there will be impacts to uh, think of it like people that work for government agencies. If you're in the public sector, you can be impacted. This can significantly impact the economy as well from a GDP standpoint, from stability. So, yeah, the market I think is waiting for this. Again, like I said, historically there is precedence to say that they will strike a deal, but in the time we live in now, who knows, right? For all we know, it could be this black swan event. But as of right now, yeah, I think the market's waiting. We do know that I think June 1st is that kind of date where, you know, I think Janet Yellen, Treasury Secretary to the current administration, has said that I think June 1st is that kind of date where the Treasury will run out of money. So they need to increase that debt limit ceiling. I honestly feel like this whole debt limit ceiling thing is such a garbage fiasco because every time they effectively hold the American public hostage, where most people don't care, most people don't know, but for those that do, especially nowadays where everyone's a little bit more in tune with what's going on politically, geopolitically, economically, uh, if you really think about it, they're holding people hostage. They may do their dealings inside, behind closed doors, but the average person, you're thinking, what the hell's going on? Is this gonna impact my pension? Is it gonna impact, my kid who works, in this industry, or is this gonna impact, uh, you know, effectively the healthcare, or is this gonna impact all these things? And yeah, it can, and that just sucks because the average American didn't do anything to deserve this or be on the hook, so to speak. Uh, and if anything, now more than ever, we continue to need that stability. But here we are with when it comes to politicians and all this nonsense. I feel like they need to get rid of this whole thing where every 2 to 4 years they do this. Like, oh, we're gonna go back and forth in this whole tough man, kind of bullcrap between these two sides in Congress and deciding, do we raise, how much do we raise, and it's just like a tit for tat type of thing. You give me this, I give you that. Oh, we agree. Oh, we don't agree. But the end result is they approve. But then why go all this? Why do this political circus? Why not effectively just sign off on it? Why not do this beforehand? Why the hell do we need to be 2 weeks before uh, a total, you know, lack of funding or lack of money in the treasury? Like it just sounds so absurd. Imagine, none of us could advocate for saying, okay, well, 2 weeks we're going to completely run out of money. But here we are with the U.S. government playing that role. Like it's pretty ridiculous. I just find it so ridiculous, and it's kind of like a farce. It's kind of like this merry-go-round circle where it you kind of diminish the credibility of the U.S. plus the system and obviously the jokes that are the politicians. But that's my take, and that's an unbiased take, as always. I'm just spitting facts. Maybe those that are very politically sensitive or very patriotic, which is fine, might not agree with me. But if you look at it, I'm merely telling you what happens historically, what the precedent is, and how these things work. And you'll see that in the next week or two, they're going to be, oh, we might do this. We're going to make consolidate. We're going to make a consideration for this thing, and we're going to remove this out of this, and we're going to give this. We're going to take that between the two sides, and then they'll strike a deal at the last little bit, while the American public's thinking, well, what the fuck have I been waiting for? Just get it done with.
Yeah, I think the best thing you said there was jokes, that is politicians. I have to agree with you 100% on that. No matter which side of the aisle you stand on, left wing, right wing, same bird, in my opinion. So, yeah, it really is kind of frustrating when they play these games with, our livelihood. It's really what it comes down to, and it's very
I also want to
frustrating.
say, yeah,
Yeah.
sorry, yeah. I also want to say something else as well that I've been having. I had this conversation with a friend of mine, and I said, and I think it's prudent because it applies to, I would say not just the U.S., but pretty much every Western developed economy, whether it's Canada, U.S., whether it's Europe, wherever. What has happened over the last 2 to 3 years is, even before COVID, we had a massive wealth gap where there's a hollowing out of the average person, the middle class, right? So what's happening is the middle class, either two things happen: either they end up lower middle class, or they end up being more impoverished, or the middle class, which is very rare, ends up becoming not middle class and going upwards, having that upward trajectory, which is very, very rare. Believe it or not, as much as the politicians and people would want you to think that, the upward mobility is actually quite hot, like hard. It's possible, at least it's possible, but it's very hard. It's mostly the rich getting richer. And I'm not going to come in here with the Robin Hood type of spiel where, take from the rich and give to the poor. That's a whole different, conversation. But what I'll tell you is, after COVID, the wealth gap, and we have data for this. This is not just me telling you anecdotally. There's data for this, that the wealth gap since before COVID, which was already horrible, has actually gotten worse, much worse. If we look at it from a graph, it's actually parabolically upwards in terms of how bad it's gotten. So it's gotten much worse parabolically since COVID. And why has that happened? It's because the politicians, and Chris just said, left, right, fuck it, doesn't matter. They've all fleeced and robbed from the average person. They've robbed from the middle class. And guess who benefited the most? It's not the lower class. It's not people that are, on the line of poverty or barely making ends meet. It's the people that are at the higher echelon of the income and wealth, uh, I would say, percentile. They have benefited the most. So you would think it would be opposite, right? You would think that, okay, give a little for those people that are all the way at the top, give a little so that we can balance the scales. No, it's actually been taken from the middle and primarily gone to the top. We see this. Then let me tell you something anecdotally, okay? We see this because I'm a big car guy, okay? And I follow cars, all everything to do with cars, primarily the more expensive kind. And I could tell you, for example, specifically Lamborghini. Let me give you an example. So again, it doesn't matter if you're into cars or not. It makes no difference. But listen to this: the new Lamborghini Revuelto. Doesn't matter if you care or not what it is. It's going to be approximately 600,000 dollars. Let's say, okay, let's say 500,000. Easy number. Guess what? They're all sold out for the next couple of years worth of production. Who's buying that? Not the average Joe, not the average Sally in middle America. They wish they could, but they can't. So who's buying it? It's all these guys that already got a shit ton of PPP loans. The government gave them so much money to hire people for their quote unquote small business that ultimately only ended up hiring their family members. And guess what? They had a lot of funding that was just, forgiven. In fact, there's politicians, I'm not going to get into the right or left because there's people on both sides that took PPP loans, and those PPP loans were forgiven. I I plead you to look this up. Okay, if you're listening to this, look this up. Do your due diligence. You'll see that there's plenty of politicians that took PPP loans. Imagine they're working in government for the people, right? It's called a civil servant. You're working the public sector for the benefit of the public, and you're a civil servant, quote unquote. But guess what? They took these loans, okay, for whatever reason. Maybe they have a business that they feel like they needed funding or whatever. But guess what? They took not 5,000, 10,000. We're talking hundreds of thousands of dollars worth. And in my research, I found that many of the small businesses that needed this funding when they shut down the economy didn't get it. It's the bigger businesses, it's all these large conglomerates that really didn't need it, but they took advantage of the system. Right? You have these slimy, quote unquote entrepreneurs and business people that effectively took advantage of the system. And guess what? They made out like bandits. They were able to compound their wealth over the last 2 to 3 years. Whereas the average person has now, after the last year, the increase in rates has only gotten worse financially. I can tell you right now, just from recent data, and this was shared in leads, I believe the total credit card debt is actually at all-time highs, and it's approximately $1 trillion. It's set to cross above $1 trillion credit card debt. Okay, this is up 20%, 21% from 2021, and it's an all-time high, like I said. Just think about that for a second. $1 trillion in credit card debt, just U.S. citizen. Okay, all the 300 something million US residents combined have approximately $1 trillion in credit card debt. Just absurd. And imagine the interest, whereas interest on average credit cards is now near all-time highs as well, of about 25%. Just think about this. So what have they done? They've hollowed out the middle class. Again, this isn't supposed to be like a diatribe or rant, but this is important for you to understand because that impacts the economy, that impacts the average person, that impacts you, everyone. And I feel, borderline criminal. And who's done this? It's not, the average person. It's the people, the politicians that so many people revere, idolize, worship, I would even say, on both sides. They have done that. They have done that. And this, I honest to God tell you, this is a fact. It's these people in their ivory towers, like I've been saying for the last 2 years, these people that look down and make these decisions who really don't know any better because they're not the average person. Guess what? They've hollowed out the middle class, made it harder for the average person. That could be you, that could not be you. It depends, it's up to you to decide where you fit in to that percentile. But guess what? The people that are at the top, they're buying up shit like nothing. Demand hasn't gone down, even though interest rates are high. Pricing for cars is higher. Guess what? These guys are still buying brand new Lamborghinis that haven't released yet, and they're pre-ordered it 2 years in the future. That's not just one model, right? That's giving you a very specific anecdotal evidence, and you can look this up. Again, this isn't just something that I cooked up. You can look this up. Pre-orders demand is absurd for these kind of cars. Not just Lamborghini, but it's absurd. You would think the opposite, right? Economy is slowing down. Oh, interest rates are high. Nope. The guys at the top percentile, they don't care. They don't care, right? So we have to really look inwards and see who are we looking to quote unquote save us. And it's those very people that have actually screwed us, right? They're not there to save you. No one's coming to save you, right? So it really blows my mind that the very people that people look up to are the very people screwing those same people that worship and idolize and revere. It just blows my mind. It's one thing to, look to the left or the right and the politicians and these so on and so forth. But if they were doing good for you, fine. It's actually the opposite. It's the literal opposite. They are effectively robbing from you, your kids' future for the here and now, and for a demographic that's very small. It's a few percent of the overall total U.S. population that's benefiting from the policies of the last 2 years. So think about that the next time you sing the praises of any politician or anyone in power in the political or economic system.
Well, if y'all wanted a good Riz rant, I managed to get it out of him tonight, so y'all are welcome for that. Abhishek has a quick question here. Let's handle that and we'll call it a night. Abhishek wants us to take a look at Tesla, says it's looking a little bearish on Friday, and I would say, yeah, we took a pretty big hit on Tesla. Riz, what's your feeling with Elon and his car company?
This is a tough one. We've seen the 166, 165 area kind of hold as previous support. I have purposely chose not to trade this, not to touch this. It moves big. It's pretty erratic. Honestly, I've not been able to figure out any kind of rhythm or consistency in the way it moves. And I think people are just waiting. We do know recently, as just a couple of days ago, Elon had announced that he will be at Twitter. Obviously, he still has Twitter, but he will be taking a little bit less of an active capacity as CEO instead of, you know, moving on to the CTO role where he'll be in charge of products and overall strategy. But the day-to-day, the more active stuff, he will leave to the CEO, which is a new lady. I can't remember her name. Uh, but something interesting is she uh, actually is or used to be a former World Economic Forum uh, participant or something like that. And I don't know. I think that completely goes against what Elon was touting, anyways, of going against the green and going against the establishment and all that. But here we are, right? He's really hired her based on her prior experience of shoring in and bringing in advertisement dollars and bringing in ad revenue and bringing in the corporations to effectively utilize ads on Twitter. So she's kind of that kind of person that he's gone with, and she has some experience in that side. But guess what? For those of you that were thinking, oh well, the World Economic Forum and Klaus Schwab and all that stuff, and if you don't like that, well, guess what? The new CEO is someone who has some incremental dealings in that World Economic Forum.
Yeah, this is a tough one to call, honestly. Like you said, Riz, this 166 area has really held pretty strong. So I think it'll be interesting to see what happens to this one on Monday. And I don't blame you for not trading this one. Rather, it is difficult to get a handle on. So yeah, tough one on this one. I would just kind of leave it be until it makes a decision on a direction. That would be kind of my advice because yeah, we had a big move down, but if we just hit 166 again and bounce, that's going to be a heartbreaker if you take that one short for sure. I want to thank everybody for coming out tonight. What an amazing conversation. It was great having you on the show, Riz. As always, it's a blessing. And we hope you all have a great week. As always, anything you want to say in closing, Riz?
Nope, it's great. Hopefully you've gotten a little more context, not just from a market standpoint, but from an overall uh, life standpoint. I think it's important to identify these things and be aware of these things, and not just simply look at lines and be like, oh, well, okay, this is moving up, and those things are fine. But as traders, as investors, as people who are looking to become financially, you know, competent and grow our finances, grow our wealth, uh, it's important to be aware and aware with as minimal bias as possible. Uh, it's hard to do, not easy, but it is possible, and I think that should be the ultimate goal.
Well said. And as always, we'll see you in the market on Monday.